Dear all, thank you for participating in today's webinar. My name is Massimiliano Pellegrinelli, Senior Strategist at Systematic Gains, part of Trend Rating, and I'm delighted to guide you through Systematic Gains model portfolios to show you how our approach can help optimize investment strategies through data-driven insights. So Systematic Gains is a forefront portal designed to systematically provide both long-only and long and short model portfolios across key global developed markets with a rock-solid bold aim to outperform the benchmarks every year. Our proprietary methodology focuses on identifying securities with high liquidity, strong fundamentals, and positive trends, helping investors capture performance and delivering continuous value over time. So there is a common problem in the industry. Let's face it. Traditional investment strategies aren't cutting it. Time and time again, active managers fail to beat the benchmarks. In fact, over 70% of them underperform across a 3, 5, 7, and 10 years periods, according to the latest SPIVA scorecard data. It's not just mutual fund, actually. Active ETFs and managed accounts often fall short too. So why does this happen? It comes down to human nature. Discretionary investing is full of personal biases, overconfidence, subjective opinions, and untested assumptions. Forecasting trap sneaks in, decisions get clouded, and the result is pretty predictable: underperformance. Now, imagine a smarter way, an approach built in logic, evidence, and discipline rule, with computer-driven strategies. There is no room for human error. Every rule is applied consistently, and every step is transparent. In short, systematic strategies let you stay at the forefront of investing innovation. So we strongly believe that systematic investment methodologies can deliver the value that investors expect and deserve. But why does a systematic methodology work better? It really comes down to two things: discovery and execution. First, the discovery process. With systematic investing, every rule is tested against actual historical outcomes. That means decisions are grounded in evidence. So we look at what has worked and what hasn't, and why actually. Through this rigorous testing, we can uncover the rules that constantly capture alpha, real opportunities for outperformance. Next, combining the rules intelligently, we explore different combinations, often blending solid fundamental with strong price trends to find the mix that historically performs the best. Finally, execution. With a systematic approach, rules are applied consistently and without deviation, so the process remains coherent and disciplined. No human errors, no emotional decision, no shortcut. So how do our model portfolios work, actually? Here is our systematic model portfolios work. First, discovering the best rule. We start by extensively testing different selection parameters to identify those that consistently produce the most alpha. Then finding the winning combination. So next, we compare alternative mixes of the best parameters to uncover the sequence that deliver the strongest results, always grounded in solid fundamental and validated by positive price trends. This is fundamental. And then validating performance. Finally, we rigorously backtest the strategy across the historical market cycles, documenting the real value, reliability, and the consistency over time. So let's dive into a few sample model portfolio. If we click on Discover our systematic model portfolios, we land in the menu. We have the possibility to view all the long-only and long and short model portfolio, as well as the selection of the one-year top performers quarterly rebalanced. We found that even with a quarterly rebalanced approach, can still deliver substantial returns while mitigating risks and keeping a low turnover. So in this case, I am logged in as an active trial, an active users. Users can simply register by filling out the sign-up form, and then a systematic gain representative will then follow up within 24 hours via email, providing the access credentials to the users. So for example, let's click on this US 25 Growth for Q model portfolio. We immediately land in the historical performance tab, where we can see the rules governing the strategy. So in this case, we are in the US market. We start from the 800 per highest market cap in US. We put a minimum daily liquidity filter of above $5 million, maximum exposure to single sector of no more than 30%, and then the selection rules. So we select those stocks with the best last 3 months sales growth, very strong smart momentum and trend strength, and the validation of a positive price action validated by our proprietary trend rating model. We also prioritize stocks with high market cap, for liquidity. Then we rank the universe also selecting those with the best last 3 months earnings growth, applying a smart beta approach against the S&P 500. The strategy is rebalanced on a quarterly basis. So it is interesting, for example, then to see the performance of the strategy. For example, the number of negative versus positive quarters. Let's say quarters exceeding 5%. In this case, the negative quarters exceeding a loss of 5% are just 3, compared to those positive, which are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 quarters. So the number speaks for themselves. And again, we don't pretend to always deliver substantial return, as this is clearly not possible, but our model portfolios tend to outperform the benchmark, in this case the S&P 500 with high consistency. Secondly, we move to the holdings tab. In the holdings tab, the user can access the holdings as of 3 months ago. In order to view the positions as of today, users will need to subscribe to our services. Then we have the chart section. In the chart tab, we provide view of the strategy versus the benchmark, along with the number of positive versus negative quarters on an absolute and on a relative way. In the historical portfolio tab, users can view the historical allocation at any point in the past up to 10 years in order to provide full transparency. And again, the most recent allocation is as of 3 months ago, as users will need to subscribe in order to see the latest allocation. In this case, again, the strategy is quarterly rebalanced. We can see, going back in the past, the list of the stocks get updated to provide full transparency. So now let me switch to another subscribed account. Here we go. To deep dive the last rebalance. In this case, professional investors, once subscribed, can immediately access the orders for the positions that require buying, selling, increasing, or decreasing exposures. In fact, if I move to the holdings tab, we can see this is the list of the holdings as of today, according to the latest rebalance. So, to conclude, concerning the cost, here's the good news. We don't charge a traditional management fee. Instead, it's just a small subscription fee, and you can opt out at any time, so there are no strings attached. The license fee is fixed, no matter how large or small your portfolio is. That means your costs are predictable, scalable, and transparent. No surprises, no hidden charges, just smart investing made simple. Concerning the execution, all of our model portfolios focusing on large cap stocks with high liquidity, which makes them easy to follow and replicate. Some portfolios are rebalanced monthly, while others are adjusted quarterly. Either way, the process is simple, fast, and efficient, so you can implement the strategies without unnecessary complexity or hassle. What are the advantages? First, high returns. So if you're looking to get more from your listed equity exposure, these portfolios are designed to deliver just that. Take a look at our catalog, explore the performance of the years, and see how it stacks up against you're currently invested in. Second, save on the fees. Why paying hefty fees on average products or managed accounts when you could keep more of your returns in your portfolio? This approach is about efficiency and value. Third, robust and consistent management. Our strategies aren't based on hunches or subjective decisions. They are systematic, rule-based, and truly tested. That means you can finally say goodbye to the uncertainty and inconsistency that come with discretionary investing. Fourth, full transparency. Every holding in the model portfolio is visible to you, giving you complete clarity and extra layer of quality control over your investments. And finally, easy execution. So rebalancing is simple, whether monthly or quarterly, non-complicated process, no stress, just disciplined, systematic investing that works. So what we provide is free evaluation. We provide free access for a free trial period to all of our model portfolios, so you can explore, track, and analyze their performance at your own pace. There is no pressure, just the opportunity to see for yourself how a systematic approach can work for you. So I encourage you to sign up for free. Thank you very much for your attention. This is the Systematic Gains. This is the future. Again, thank you.
All right, thank you, Max. Appreciate the demo, presentation, and an explanation in terms of how everything works. To those in the audience, we have a Q&A time now. Now, as a reminder, questions can be asked throughout the entire webinar. We did receive a couple of them. If you haven't had the chance to key them in, look for the Q&A box on the bottom. Crack that open, type your questions in. We had a couple of them, as I said. I do have one pre-prepared question because, Max, this is one we get all the time. How do family offices use the model portfolios?
Very nice question. Thank you, Alan. So once the family office subscribe, we provide a username and a password. It's very simple. At the end of every month, he or she will get the new allocation of the stocks in order to give the orders to the broker and execute the trades. It's pretty straightforward. So he or she will be notified about the stocks that needs to be sold or bought.
Okay, thank you, Max. Moving on to the questions that were submitted prior to the webinar. How consistent is the outperformance of the model portfolios over the years?
So the outperformance versus the benchmark is pretty consistent. We have 80% of the success ratio in terms of beating the benchmarks. This is because our model portfolios got stress tested across several cycles, several selection rules, ranking rules, in order to find the best winning mix across global developed markets and sectors. So what we provide is a pretty unique set of model portfolios designed to beat the benchmark every year.
Thank you. Next question. Why do these model portfolios beat the indices and funds?
So the majority of the research out there create a lot of noise, always most of the time producing also value that is highly debatable. What we bring on the table here is a pretty unique solution, enabling professional investors to consistently deliver alpha, also in volatile time, also in volatile markets, in bear markets. So our risk-adjusted returns model portfolios tends to be reliable also during uncertain times, and this is one of the strongest added value we bring on the table.
Moving on to the questions that were submitted when you were speaking earlier. How complicated is it to replicate the model portfolios in an account?
So it's really easy to replicate one of the model portfolios. In this case, what we provide is the historical allocation of the portfolio. The user can keep track of every position at the end of every month or quarter. And in this case, he or she will receive the new list of the stocks at the new rebalancing date that just need to be executed.
Okay. Moving on to our last question, Max. What
Yes.
is and again, a reminder to anyone, if you have any questions you want to key in, type them in here. Otherwise, you can send it to us via email afterwards and we will respond. But the last question we have, what is the turnover and the impact of brokerage fees?
Thank you, Alan. So we tend to keep a pretty low turnover, as we know that this is one of the most important things for investors. They don't want to rebalance the portfolio that much, of course, due to taxes reasons. So the turnover tends to be relatively low. And we do not charge performance fees or management fees. We charge a pretty low flat fee. So this is also part of the scalable process that we provide, also for our commitment to delivering superior value over time.
Okay, well, thank you, Max. I'll pause just for another few seconds to see if any other questions come through. All right, if there are no further questions, Max, any last words before we sign off for today?
Thank you very much, Alan, for your time. Thanks to the audience. Again, I encourage everybody to just have a look, explore our catalog of model portfolios, long only and long and short. And in case, subscribe for a free trial. Of course, we do provide up to 1 month of free trial to deep dive the rules, the governing the strategies, the holdings, the allocation, the geography, the sectors. Everything is transparent.
All right, cheers. Thank you, Max. Thank you to everyone in the audience, and we'll see you next time.
Thank you,
Bye for
Alan.
now.
Thanks, everybody. Thank you.